Good afternoon. This is Jim Barlow with OakTree Strategic Leverage. Happy to be with you this afternoon. I'm always trying to refine a presentation to do a better job. But anyway, Inversion Wealth Framework. This is my framework to help people have a better life. Um, why structure matters more than returns. We'll be kind of talking about that, but featuring the 8% retirement strategy. You maybe have never thought about how much you can pull out of retirement. We'll show you. The requirement question is how much can I safely withdraw without running out of money? I'm sure you've asked that. Everyone asks that. How much do I have to have? Well, in 1994, a financial planner, William Bengen, he analyzed nearly 70 years of historical market data dating back to 1926. He asked that question: how much could a retiree safely withdraw each year without running out of money over a 30-year period of time? Well, that's kind of the goal. If you're 65, 75, 85, 95, or if you're 70 to 100, you want to have income for another 30 years. Well, his study was 4%. Probably most of you are saying, well, 4, that's not very much, but let's go over this a little bit. Why only 4? The real danger is sequence of return risk. If when you retire, let's say you start with $1 million, and the first year you have a horrible year and you're down 20 or 30%, and you're withdrawing, you'll never recover. And that's what I've said there: permanent portfolio damage. With the withdrawal rate, if you're investing all your money, had to be conservative so that it would last the 30 years. The traditional 4% rule is designed for one purpose: to avoid running out of money. But modern strategies, including myself, we aim for something better. Still with survival, with adequate income, good income, control, flexibility, protection. We want more than 4%. The 4% rule forces retirees to live on only a small portion of their assets. $1 million, that's what you have, 4%, 40,000. And almost everybody would feel, well, I look like I'm rich on paper, but only 40,000. So what if the problem isn't your investments? What if it's the structure? How you set this thing up, how you build it? Why retirement plans fail? The first one I'm going to mention is a sequence risk. You have to address that, but there's others. You know them. Taxes, you're paying a bunch of taxes if you're pulling it out of a 401k, IRAs. Inflation, it's always there. We've got to protect from that. Emotional decisions, being in investment business for 40 years, unfortunately, a lot of us clients get emotional and make the worst decision at the worst time. It really happens. Selling during down markets, you can't do that. You've got to protect yourself from doing that. You've got to avoid ruin. The structure really changes everything. In a building or a home, you want to make sure you have a good foundation. You want to make sure you have electricity, plumbing, heating, air conditioning. There's a lot of things you've got to get in line for a structure. Same with build bridges, airplanes, trees, the human body, championship teams. They have to have a structure how we're going to do this. Successful businesses, financial systems. Everything successful, everything successful begins with a structure. And why shouldn't retirement be the same? I'm going to show you a different kind of balance. Traditional retirement says, what should I own? The Inversion Wealth Framework says, how should my retirement be structured? You probably right now say, what do you mean structured? Well, let me show you a simple concept. You're going to grasp it very quickly. It's nothing, this is not rocket science. But you have a growth bucket. This is the stock market. This is the ups and downs. And you want this higher average. And then you need to have a stable bucket. In up markets, you're going to withdraw from the growth. But in a down market, you don't want to withdraw from the growth. You want to have a stable bucket to withdraw from. This is the simple concept. Strong markets withdraw from growth, leave stable untouched. Down markets withdraw from stable, leave growth untouched. This is one simple rule. Never withdraw from equities during down markets. But if you have only equities, you've got a problem. Retirement isn't about what you own, it's about when you're forced to sell. You don't want to be selling in a down market. I asked AI to create some graphic for me, some never selling in down market. So there's the thunderbolt and the lightning, and then the beautiful day. It's kind of a nice AI generated picture. Let's give you a major example. Let's say you're retiring January 2008 with 1 million, and your plan is not 4%. You want 80,000 a year. Then the market declines 38.5%. Oof. Question is no longer how do I earn a higher return? You're not concerned about that anymore. The question is how do I avoid destroying my retirement? That's when retirement stops being about investing and starts being about the structure. Did I set this up right? The calendar year changed. Now we're in 2009. The crisis did in the market had already fallen 38.5% in 2008, but it dropped another 25% before March 9th, 2009. If you're withdrawing income during that period, your greatest risk wasn't the volatility, it was being forced to sell when prices were lowest. You know, let me mention a client. Um, I I lived through 2008, held clients' hands. Had this one client that was pretty aggressive in his approach, and he's called me quite a few times in 2008. Jim, what are we going to do? What are we going to do? Then eventually he was saying, we got to get out. We got to get out. And then it was really close to March 9th. He'd gone through the negative 38. He'd gone through another 25%. And he called up, Jim, I want to sell. You can't talk me out of it. I want out of the market. I don't want to lose any more. In the investment world, amongst investment advisors, we call that capitulation day. It happens. It's a human nature thing. Jim, get me out. And we did. I remember on the phone, I said, okay, I'm doing it. But I want to set up an appointment. We have to decide what we're going to do from here. We just suffered a major loss. And then I said, we're going to have to decide what to do. I got together showed him every possible way, but he wasn't interested. He took his loss and moved on. Well, tragedy. But you probably all thought of this. Where do you invest your stable money? This is the weak link. You mean I have to put this in money markets or something with low return? Well, the traditionally safe money would be you do. You're trying to protect your principal. It's going to produce limited growth, often losing purchasing power to inflation because you don't have any return. That's the traditional safe money. What if your stable bucket could protect principal? That's essential, obviously, produce income and a good income. Oh, reduce taxes too, increase flexibility, leave a legacy. Does such a structure exist? Well, there is. And at the end, I'll show you a little more detail. But the strategy that I use is called Kaizen. You don't need to know all about it right here and now, but Kaizen, protection, still has growth potential, income, tax efficient, legacy. Part two, we'll get into that. So maybe I didn't make this case very strong, but instead of 4%, you really can do 8%. By pulling out in up markets, 8% from your growth bucket, 8% of the total, incomes come off growth, and down markets, you take it from this stable account. And I've teased you with this Kaizen. It could be a better stable bucket than money market. Let's go into some principles here. I'd like to tell you about my inversion wealth framework. The guiding question for this concept is what could cause this plan to fail? There's four principles. Inversion. Identify and avoid the causes of failure. Invert the problem. Protect the downside. It's a belief, it's a concept of what you're going to look for. Something that avoids failure. Two, with that in mind, you build a structure. And if you have a solid structure with protection, then you can use some leverage, strategic, conservative, to give you a better return. Then you can let patience work its thing. Investing is a lot to do with patience and have the results, better outcomes. When you consistently apply these principles, you are going to have better outcomes. Here's a graphic of it. Inversion, structure, leverage, patience. Then better outcomes is the result. This framework can be used for obviously retirement, but it could be used for business succession, executive benefit, family gifting, wealth transfer, tax diversification, legacy planning. It can be used for a lot of reasons. Principle one, winning begins by avoiding failure. Instead of asking, how do I succeed? What could cause this plan to fail? The goal isn't simply to achieve success, it's to eliminate predictable failure. Applying inversion, before building a retirement plan, you identify the causes of failure, sequence of return risk, taxes, inflation, emotional decision. If you have better handle, better questions, you're going to have better decisions. Principle two, structure. Make sure the structure is based on your inversion principles. Build a structure that will withstand the problems. The, um, every successful system begins with a structure. I mentioned this a little earlier. Structure determines outcome in every domain of life. I've put together, I think, kind of a fun example um, for you, and here in Utah, you'll get a kick out of it. So, Nauvoo, the Great Salt Lake Valley, was 1,300 miles away. This is the 1846, 1845. A pioneer wagon had to keep moving across rivers, mud, prairie, mountains, rock, desert. This is the structure that gave you survival. Brigham Young required inspections. He appointed Apostle Ezra T. Benson. He said the departing cattle wagons teamsters would have to pass the inspection of a competent person to assure that all may start in proper condition. In the same instructions, Brigham Young said, send only good iron axle Chicago wagons, or failing that, at least a wooden axle Chicago made. He was telling, we're going to inspect your wagons. Do you have a wagon that's solid and built? If you don't have a good structure, we're not going to let you go. He was trying to protect their lives. Brigham Young asked a fellow by the name of Israel Barlow. He was my great-great-grandfather to remain in Nauvoo and continue to make wagon wheels for the saints. Instructed to build wagons and wagon wheels so families could leave Nauvoo. He was instructed to help saints prepare to cross the Mississippi. He was there to care for the poor, the sick, dispose of property. He had quite an assignment, but he was there to keep building wagons and wagon wheels. Before Israel Barlow ever crossed the plains, Brigham Young gave him a different assignment. He said, stay behind, build wagon wheels, because they understood something important. The success of the journey didn't begin on the prairie. It began in the workshop. A failed wheel could end the family's journey before ever reaching Rocky Mountains. You had to have the right structure, and you had to have it built properly so it'd weather the storms. The success of the journey didn't begin on the prairie, like I've said. It began in the workshop. Brigham Young understood that a failed wagon wheel could end a family's journey before it ever reached the Salt Lake Valley. Great pioneers didn't simply prepare for success, they engineered against failure. The same principles apply to retirement. Before you talk about investments, products, returns, we should ask a better question. What could cause this retirement journey to fail? Single question is the foundation. That is the foundation of Inversion Wealth Framework. So, great structures don't happen by accident. They're designed to survive. You've got your principles, inversion, you've got your structure. And because you have a great structure, you can use some leverage, the capital. Leverage is something we use in almost every day in real life. We leverage the knowledge. We leverage people, employees. We leverage time. We use leverage in a lot of areas. Capital is the one you always think of, but it's all these other areas. And it's a principle that all can use properly. Kind of redundant here, knowledge, and okay, I'll skip that one. But principle 4, it's not investing if you're trying to sell the next day. It's not day trading. Patience is the ultimate multiplier. You have a great structure, improve with time, compounding rewards, disciplined decisions. Gives you better outcomes. Better outcomes, higher income, lower stress, better decisions, more confidence, greater legacy. Better outcomes isn't really the goal. They're the result of the 5 decisions that came before. So a different approach. I teased you with Kaizen. Kaizen is a one is based on an index universal life policy, a cash value life insurance. We have index interest crediting strategies. I'm going to show you. Has potential market linked growth and zero downside with no market investment, no direct market investments. Index crediting, potential market link, no downside. That no downside is the structure part that's really important. One structure, like I said, you can use this for retirement, family gifting, executive employee benefits, business succession, legacy planning, family gifting, wealth transfer, tax diversification. You can use it for a lot of different reasons. Liquidity planning. So I've cut Kaizen into 4 sections. And I've listed every basic feature that you need to know. I'm going to show you these 4 sections and cover pretty quickly the concepts. Let's show you the foundation. Is the life insurance policy. So, boom, day one, you've got death benefits to protect your family here and now. And these are modern policies. They have living benefits, protective when life doesn't go as planned. Let me jump ahead and then we'll come back. These living benefits, you have riders of critical illness, lump sum for major health issues, critical injury, support for severe injuries, chronic illness, long-term care needs, terminal illness, cognitive impairment. The world today, the life, cash value life insurance has living benefits, which are benefits for you and your family right here and now. Death benefits, living benefits, tax-free growth and access. When a person dies, their life insurance proceeds go to their heirs tax-free. That's the law. It has been for over 100 years. They've never changed it from day one. And why should they? This is a situation the breadwinners just lost their life, and the government wants this family to pay for their own way in the future. So it's tax-free. And we have access to these funds. Before you pass away, you can borrow for the policy tax-free. Efficiencies, there's no advisory fee. There's no management fee. You've eliminated some costs. You picked up a life insurance cost, but you've eliminated costs also. And you have the death benefit and living benefits. Growth, second category. Downside protection. Lost years are eliminated. In an index universal life, I'll show you a slide in a second, you can't have a negative year. The worst year is 0. That's pretty cool. Market linked upside, participate in market gains. Continuous compounding because you don't have to recover from the down year. And then you have this tax-free income availability, tax advantage. Let me show you these things. In an index life policy, most of the money beyond the insurance costs is going into a high-grade bond fund owned by the company. And so by far the majority of $1,000, probably 950 or 900, a little lower, but by far the majority is going into a fund with no downside because of the bonds. This money grows back in 1 year to 1,000. Therefore, you have some money to buy options. This is how you replicate the market, by having options that can go up. You can see it's money safe, it's conservative. And then you have the option, you've got this availability to be in the market, get market-like returns. This is really, really busy, but I want to give you some real numbers. This is a page from Allianz, one of our vendors that we use a lot. And it kind of, I don't want to explain all these details, but if we start at the bottom, one of the investment options is the S&P 500 Index Annual Point-to-Point investment. And this approach, because your options can only buy so much, this has capped performance at 12.25% cap, meaning if it goes to 15, you only get the 12.25. But if it goes to negative 20, you get 0. It's protecting your downside. And here's the performance over 5, 10, 15, 20, 25 years. Pretty close to all each other. What do we got? The low 7.6 to the 9.6. Then we have other index options. And I don't want those 3 sections above. Let's just do the bottom one. Classic index allocation, 1% fixed rate bonus. Here you have different investments, and they don't have a cap. They have a participation rate. And the two in the middle, Bloomberg and PIMCO, has 190% participation. You get 190% of the return and 185% with no cap. And there's the numbers you would have had in these over the years. So you can see we have another option with no downside. And recently, Allianz came out with these other two, the blended futures with a participation rate of 95, and the S&P 500 futures with a participation of 60. This is how much they could buy currently of this index. They're giving quite a few options with protecting people's wealth. So now we're going to the third. We had growth with no downside. We had the foundation. Now with the leverage, we do approximately 3-to-1 leverage. We borrow money. We have money, other people's money working for us. And the way we built this, there's no personal guarantees or outside collateral. This is pretty amazing. Most people say, how do you do that? And with no downside, you can have accelerated outcomes. Every year could be an accelerated outcome because you're starting from a higher with a protection value. Very efficient way to use money. No downside, market link returns. The leverage is important. Here's a diagram I put together how this actually works. You have, in Kaizen, you have 5 annual payments, or you can do it in monthly payments over 5 years, your choice. That's it. You can't put money in afterwards. You put in 5 years of payments. And while you're doing that, the bank is putting in approximately the same amount that you are for the first 5 years. After 5 years, you're not paying any more money, but they're making their contribution they were making for the first 5 years, plus they're really replacing you and putting money in for 10 years. So you can see that you get a lot more money in if the market's going up. This will outstandingly look amazing. So I mentioned kind of this, no personal guarantees, no outside cloud, no traditional loan process, institutional underwriting, the way we build it, you don't have any of this. It really isn't total. I know we've eliminated no downside, but we've structured this and we found the right product we can buy so it can't break you. Last is the control. We set all these accounts up in a trust ownership. We set up a trust for you, and then we have a master trust. The master trust is doing the he's doing the leveraging, getting the borrowed money. You don't have to do it. There's a 5-year funding. We have a bunch of riders on this to all protect people's money, have their money available. Flexible liquidity, you have access to cash rate, no forced withdrawals, no RMD, just minimal management wealth. Works very well. There's all the protective issues. So here they are, the 4 areas: foundation, growth, leverage, and control. All these things we put together to build this product that does some amazing things. Let me give you a simple case study. We got a 40-year-old, male, age 40. He's willing to contribute $25,000 for 5 years, or $125,000 total. He wants income, retirement income starting at 65. Excellent health, non-smoker. We're going to use a growth rate that was set by the NAIC at 6.84 in June 15th, not too long ago. We mentioned this excellent health. Kaizen can take average health. Can't really have rated health policies. You can have average or excellent health. If you have less than that, then it's probably not something you could have or should consider. So here's the results. 125,000 total on his part. We're going to start giving him 72,000 income starting at that age 65. And through age 100, he's going to get back 2,592,000. So it's good to be. Well, if you bought this policy with no leverage, the income would have been 46,000. The leverage helped quite a bit. Or, I just commented, this is 56% higher from 46 to 72. That's a pretty good return. After tax investments, after the 125,000. Oh, I'm sorry. I probably should have put some zeros there, but instead of I'll have to work on that to make sure I got it accurate. I might have it wrong. Oh, I'm okay. I know what I'm doing now. I forgot. So I have the Kaizen income per year, 72,000. I have the same policy without leverage, 46. And this is an after-tax investment through age 100 using the same growth rate. In other words, 26,000 income versus 46 or 72, 270% more than this Kaizen. I'm sure quite a few of my clients or my family is going to buy this just for that reason. Now, I want to show you a policy. This is the very first policy issued. This is in June of 2024. This is the first statement. 1 year later, well, it was issued every statement every year, and this is the 2025. I have not been sent the update for 2026, but this first policy has averaged 7.85% return. They've on an average paid 3.95% on the interest. 7.85 subtract 3.9, they paid 3.59% on people's other money. And I want to show you how the market's performed. Long term, it's averaged about 10%. Here, we're going to take 25% tax, pretty high. Go to all like and have you watch it more carefully. So there's those two examples. One more point. NIW, that's the founders of Kaizen. They looked back to the 1930s and they found no rolling 15-year period of time that the product hasn't produced a spread of 2%. Nothing lower than 2%. So that's, if you can always make 2% on other people's money, that is worthwhile. This is kind of a different knife, but we can use it for tax treatment, for growth, for leverage. We got the protection, we got the controls. Without losing, structures the edge, and you get better performance. And that's me. As you have questions, there's my phone number, there's my email address, there's my website, and the QR code on the right. That is a landing page where you can learn all about Kaizen. It has videos, chapters, everything you ever wanted. With that, I think you understood how we can double our retirement income from 4 to 8 by having a stable bucket. Well, have a great day. It's been fun talking to you again. Talk to you probably next week. Bye.